Good morning, ladies and gentlemen. Welcome to IGE Forum today in the form of webinar this morning. Today I'm so very excited to have an outstanding guest speaker, Dr. Ira Kalish, who is Chief Global Economist of Deloitte, Touche, Tohmatsu Limited. As we know well, Deloitte is the world's leading accounting and consulting group. And I'm so confident that Dr. Kalish's exceptional insights and advisory experiences will help us better understand the rapidly changing prospect for global economy in the face of serious challenges, most notably the escalating trade war and geopolitical tensions in the beginning of the Trump 2.0 era. Dr. Kalish is widely recognized specialist in global economic issues as well as the effects of economic, demographic, and political trends on the global business environment and strategy. He has given numerous presentations to corporations and organizations on topics related to the global economy, especially issues including relating to international trades. Dr. Kalish has been quoted by the world's leading press, such as the Wall Street Journal, Financial Times, and The Economist, among others. He holds PhD in international economics from Johns Hopkins University. Without further ado, let's welcome Dr. Ira Kalish, who will speak for about 30 minutes, 35 minutes, followed by our typical Q&A session until around 10 a.m. here in Seoul time. Hi, Dr. Kalish. Thank you very much for joining us today, especially you're joining us live from Los Angeles. I appreciate that very much. Now, the floor is yours.
Thank you very much. I'm going to share my screen to show the slides. Let's see here. There we are. And wait 1 second. There we go. Yeah, very good. So again, thank you very much for having me today. I'm speaking to you from Los Angeles, where it's still Monday afternoon. And what I'm going to talk about is how the new policies of the U.S. administration are likely to change the outlook for the global economy. But I'll begin by talking about where the global economy stood as the year began. So let's look at this chart, and this shows quarter to quarter real GDP growth on an annualized basis in the US, which is the blue line, the Eurozone, which is the green line, and Japan, which is the orange line. These are the three most important developed economies in the world. And what you can see is that over the past 3 years, the US economy, especially the blue line, has done extremely well. Europe did not do so well. Japan did reasonably well. And so as we started the new year, the U.S. economy was in exceptionally good shape. It had grown 2.8% in 2024. It had seen very strong productivity growth, which wasn't seen in other developed economies. It had very strong consumer spending growth and investment growth. But at the same time, we had seen a very tight monetary policy. And as a result, we saw a significant drop in inflation, so that today inflation is under 3%. And of course, the Federal Reserve's target is 2%. So we're very close to the target. So things were in very good shape. And then the new administration took over, and it signaled that it would focus on four major buckets of economic policy: taxes, regulation, immigration, and trade. And initially, the investment community believed that the Trump administration would mainly focus on taxes and regulation and have less of a focus on immigration and trade. So the expectation was tax cuts, as well as a lighter touch in terms of regulation and competition policy. And as you can see in this chart, which is an index of US equity prices rose sharply after the election on these expectations. But over time, it became apparent that the administration would first focus on trade policy, in part because in our system in the US, the president can implement trade policy alone. Whereas when it comes to taxes, for example, that requires action by the Congress. And it is likely that this year the Congress will take action on taxes, and it's working on that now, but it will take time. But on trade, the president could act very quickly, and he did. Initially, he proposed a variety of tariffs, and then postponed some of them, reversed some of them, and implemented some of them. Initially, the reaction to higher tariffs was that there would be higher inflation, and so bond yields increased. And with tariffs, there would be a decline in the demand for imports, which would mean lower value of foreign currencies. So that led to a rise in the value of the US dollar. But over time, it became apparent that the trajectory of tariffs was uncertain. Because the administration made a variety of proposals which it postponed or even reversed. And this led to uncertainty on the part of many investors, which led to a decline in US equity prices, which you can see in this chart, a drop in bond yields, and a drop in the value of the dollar. And that's because although investors expected higher inflation as a result of tariffs, they also expected that uncertainty might have a chilling effect on business investment and therefore slow the US economy. So before I talk about the major tariffs that the president proposed on April 2nd, let me address the issue of why the administration intends to impose very substantial tariffs. And we're hearing different reasons from different people within the administration. The president himself has said that the tariffs are meant to reduce the trade deficit. But what we know in economics is that trade deficits are generally not the result of trade policy. A trade deficit is simply a reflection of the fact that a country invests more than it saves, or another way to look at it is that it consumes more than it produces. And if you want to reduce a trade deficit, if that's the goal, the best way to do that would be to reduce consumption and increase savings. Increasing tariffs will result in currency movements that will offset the trade effects of those tariffs. Another reason that has been given is that the tariffs are meant to be high for a prolonged period of time in order to encourage reshoring of manufacturing in the United States. Another reason is to boost government revenue to offset the impact of tax cuts. Our Treasury Secretary, Mr. Bessent, has said that the goal of tariffs is to have leverage in order to compel other countries to make trade concessions, and that the goal is not really to maintain high tariffs. And finally, interestingly, the tariffs on Mexico and Canada were imposed in order to encourage those countries to stop the flow of fentanyl, an illegal drug, into the United States. But in any event, on April 2nd, the president made a major announcement, which he called Liberation Day, in which he introduced very substantial tariffs. he said the tariffs were meant to be reciprocal. In other words, if another country had high tariffs on the US would impose high tariffs on that country. And yet many of the US trading partners actually have relatively low tariffs. The average Japanese tariff on US goods is only 1.9%. The average Korean tariff on US goods is less than 1% because the US and Korea have had a free trading arrangement. And so what the president did was, rather than address the actual tariffs, he addressed the fact that many countries have large trade surpluses with the US. And so the formula for the tariffs were based on the size of the trade surplus. Initially, he proposed a 20% tariff on the European Union, a 24% on Japan, 34% on China, 46% on Vietnam. And if you look at this chart, this shows what those tariffs would have done to the average tariff rate in the United States. It would have caused it to rise to 27%, the highest since 1908. If you look at the left-hand side of this chart, the sharp increase in tariffs in 1930, that was the famous Smoot-Hawley tariff, which was passed at the beginning of the Great Depression and is widely seen as having caused the Great Depression to become much worse. If you look on the right-hand side, the Trump tariffs were going to be far bigger than the Smoot-Hawley tariff. And when he proposed this tariff, financial market volatility increased dramatically. And a week later, he said that most of those tariffs will be postponed for 90 days. However, he did leave in place a 10% tariff on every country other than Russia, a 25% tariff on steel, aluminum, and automobiles, a 25% tariff on Canada and Mexico, excluding goods covered by the USMCA, and a 145% tariff on China. So the end result was that the average tariff rate actually went higher than what you see on this chart. I said earlier this was 27. This was actually 22%, but the tariff situation now is 27%. It's much worse. So once this became evident, the financial markets started to react once again. Now, it's very important to note that a large part of U.S. trade is with Canada and Mexico, and there is a free trade agreement between the three countries. And the tariffs that the U.S. administration has implemented are potentially disrupting that free trade agreement. What we do know is that agreement must be renegotiated in 2026. And so now there's a high degree of uncertainty about how that will transpire. And it's of particular interest to companies in the automotive industry, including Asian and European automotive companies that are active in the US market, because US supply chains for automobiles are highly integrated across North America. So this is another uncertain aspect of the trade environment. But in any event, let's look at what happened to financial markets after the president announced what is now a 27% average tariff on imports into the United States. Normally, tariffs lead to higher inflation because they raise the price of imported goods. But in this case, what you can see is that recently there's been a sharp drop in expected inflation. This chart shows the 5-year break-even rate, which is a measure of bond investor expectations of inflation over the next 5 years. This dropped sharply because even though investors know that prices will initially rise, evidently, they expect that the high tariffs will lead to an economic downturn, possibly a recession, which will have a disinflationary impact on the U.S. economy. In addition, investors now believe, because of that possibility of an economic downturn, that it's more dangerous to hold risky assets. And so this chart shows how yield spreads have rapidly risen. This is the spread between the yield on junk bonds or high yield bonds and U.S. Treasury securities. And this has increased very substantially in recent weeks. And finally, the bottom chart here shows the yield on the U.S. 10-year bond, and the top chart shows an index of the value of the U.S. dollar against a basket of currencies. Now, again, normally you would expect higher inflation from tariffs, but as I indicated, investors now expect lower inflation, and that would ordinarily mean lower bond yields. But instead, what you can see in the bottom chart is that bond yields have risen instead. In addition, the top hand chart shows that lately the value of the dollar has fallen. Now, normally when investors are worried about the economy, they sell equities and buy bonds. And so you would expect bond yields to decline with expectations of a recession. But instead, bond yields have risen and the currency, the US currency, has declined. That suggests that investors are not just worried about the economy, they're worried about exposure to the US economy. And so there's been a kind of flight from the US dollar, with investors selling US dollar assets and instead buying assets denominated in Japanese yen, Swiss francs, and euros. And we saw more of that take place just today when the value of the dollar declined very sharply against major currencies after the president suggested the possibility of firing the chairman of the Federal Reserve. So now global investors don't see the U.S. as much as a safe asset as they used to, and that's why we're seeing the dollar fall and U.S. bond yields rise. So we're sort of in a new era. Initially, with tariffs, you expect higher inflation and a tighter monetary policy. We know there will be a decline in U.S. purchasing power, which should lead to a slowdown in economic growth. We also know that the majority of U.S. imports are intermediate goods used by U.S. companies to produce final goods. So that's an increase in production costs that will be passed on to consumers in the form of higher prices, but it also means a loss of global competitiveness on the part of U.S. producers. If investors expect tariffs to be permanent, then we will see a rapid redesign of global supply chains. And of course, initially we saw a rise in the value of the dollar. However, we're now experiencing the secondary effect of very high tariffs, as well as uncertainty about the future path of tariffs. So now there's an increased expectation of recession. We've seen a sharp drop in U.S. equity prices, a sharp drop in the U.S. dollar. It's likely that we're seeing investment be stifled because of uncertainty. So, for example, if you're a global company operating global supply chains, if you know for sure that tariffs will be high over a prolonged period of time, you might not be happy, but you know what kinds of investments you need to make to try to minimize the cost. But currently, because of the uncertainty over where tariffs will wind up, businesses might be putting investment on hold and waiting to see what happens. And as I indicated, we're now starting to see a decline in the dollar as a perceived safe asset. If that continues, then U.S. bond yields will rise further, which may cause difficulty for the U.S. in funding its budget deficit. And already we're seeing some cautionary signs. We're seeing, I'm sorry, that was a mistake. There we go. We're seeing, we've already seen a very sharp drop in U.S. consumer confidence that took place even before so-called Liberation Day. We've seen a drop in small business confidence, an increase in underemployment, that is an increase in the number of discouraged workers. We've seen a decline in the Purchasing Managers Index, or PMI. And interestingly, in March, we saw very strong U.S. retail sales as consumers spent money in anticipation of higher prices due to tariffs, which means that in the months to come, spending will decline. And as far as the global economy goes, we've seen strong exports from many countries to the U.S. in anticipation of tariffs, which also means that in the months to come, other countries will see a weakening of their exports. And that would probably be true of China, South Korea, Japan, and Europe. Let me say a few words about Europe. The chart here shows real GDP growth year over year up until the end of last year. The European economy was not doing well. Consumer spending was restrained by high interest rates, high energy costs. But on the other hand, the European Central Bank has been cutting interest rates, real wages are rising, and so there was an expectation that this year there would be a modest improvement in economic performance. But now things are changing. There is a perception in Europe now that the US government might not back up its NATO allies or Ukraine, in which case Europe needs to spend more on defense. And that is what's happening. For example, in Germany, they amended their constitution. They released their so-called debt brake to allow the government to borrow a lot more money to spend on defense and infrastructure. Many other countries in Europe are doing likewise, which means Europe is now undergoing a massive fiscal stimulus, which should boost economic growth. And this is already reflected in higher bond yields, higher equity prices relative to US equity prices, and an increase in the value of the euro. So that alone, that fiscal stimulus should boost European economic growth. But on the other hand, the US tariffs and any retaliation against those tariffs would obviously hurt economic growth in Europe. So there's some uncertainty about the outlook for Europe. Then China, the second largest economy in the world, has lately experienced relatively weak economic growth, in part because of troubles in the residential property market, which has weakened consumer demand, especially as it has hurt consumer wealth. Plus, China has seen some worsening demographics. And so in response to the weakness, there has been fiscal and monetary stimulus by the Chinese government, combined with some structural reforms, which are meant to boost economic growth, especially as there is an understanding that China cannot continue to grow simply on the basis of exports, especially given the trade dispute with the US. And now that there is this dispute and unusually high tariffs, 145% US tariffs on China, 125% Chinese tariffs on the US, that suggests that there's a possibility of an almost complete decoupling between the two countries. And not only has China retaliated with tariffs, it's put pressure on the US through restrictions on exports of rare earth minerals, and it is cutting purchases of US natural gas and US airplanes. So it's not clear where this is going to go, but it's certainly a very difficult situation. Meanwhile, China is focusing more on boosting domestic demand and seeking trade opportunities elsewhere. And indeed, there are many efforts around the world to liberalize trade, excluding the United States, as the US chooses to withdraw increasingly from the global trading system. Now, South Korea, which has had free trade with the US, has also faced the possibility of high tariffs, and including right now the 10% tariff. The tariffs obviously threaten the competitiveness of Korean manufacturers in their effort to export goods to the United States. The tariffs also threaten the integrated supply chains, global supply chains of high technology in which Korean companies participate to a very large degree. And if there are permanent U.S. tariffs, that would likely lead to a redesign of supply chains, especially in the high technology industry. But for Korea, probably the best strategy to offset the negative impact of the trade dispute with the U.S. would be to focus on innovations and productivity gains that differentiate Korean products from their competitors, and that also help to lower costs. There's no way to avoid the tariffs if the U.S. wants to impose them, but there is a way to avoid ruinous price competition, and that is innovations that do lead to differentiation. Meanwhile, Korea and other Asian countries are likely to seek further liberalization of trade within the Asian region, but also with other countries in the world, including those in Europe and Latin America, as a way to diversify their exposure away from the United States. Meanwhile, the question for South Korea and other countries is, what does the U.S. want? Because there have been negotiations between the U.S. and several countries. There have been talks between the U.S. and Japan, between the U.S. and the European Union, between the U.S. and Vietnam. And in all of those talks, Japan, Europe, Vietnam offered the U.S. 0 for 0 tariffs. In other words, we will cut our tariffs on U.S. goods to 0% if you do the same. And the U.S. rejected that. So evidently, this is not just about tariffs. Instead, it's about the perception by the U.S. administration that the U.S. trade deficit is a problem. And so the U.S. wants to find ways to reduce its bilateral trade deficits with other countries by getting other countries to agree to purchase more U.S. goods, especially liquid natural gas or LNG. And indeed, the U.S. has proposed to both Japan and South Korea that Korean and Japanese companies invest in LNG production in Alaska and commit to purchasing the extra output. In addition, our president has said he wants companies based in other countries to invest more in U.S. factories, especially in the automotive industry. So the end result is that there is a high degree of uncertainty right now. So the question then is, what happens next? And I don't know, nobody knows, but what I have here are three plausible scenarios. The first scenario is that the U.S. retains very high tariffs, which would be meant to encourage more investment in U.S. manufacturing, especially by foreign companies. And at the same time, the U.S. would then engage in some kind of fiscal stimulus to offset the impact of higher tariffs. And that would probably mean a large tax cut. If this happens, my view is that would probably lead to a U.S. recession sometime in the next year. It would lead, at least temporarily, to higher inflation in the U.S., and it would put the Federal Reserve in a very difficult position of having to balance those two competing interests. For other countries, it would mean having to deal with a very difficult environment, and again, trying to diversify trade away from the United States and focus on liberalizing trade elsewhere. But it also might involve more direct investment into U.S. manufacturing. So that's one scenario. Another scenario, which is probably the best one, would be if the U.S. Negotiates lower tariffs as well as commitments by other countries to purchase more U.S. products. That is what the negotiations currently underway are dealing with, but there's some uncertainty as to how successful this will be. For example, the U.S. has criticized other countries for non-tariff barriers, such as regulations involving product safety, and the U.S. has also complained about other countries having high value-added taxes, even though value-added taxes don't discriminate between imported and domestically produced goods. And it's not likely that other countries will be willing to lower their value-added taxes in response to U.S. Negotiators. So it's not clear how much success there will be in scenario number 2. But if there is success, that would probably be the scenario that would lead to the least incremental inflation and the least likelihood of a global recession. Finally, scenario number 3 is the one I think is most likely, which is that the U.S. strategy remains somewhat unpredictable in that there will be tariffs imposed, some might be reversed, some exemptions might be offered, and some might remain in place. Meanwhile, the U.S. would probably continue to make demands on other countries, some of which would not be satisfied, such as asking other countries to reduce their value-added taxes. Under this scenario of uncertainty, it's likely we would certainly still have some very high tariffs, which would have both a recessionary and inflationary impact. But the uncertainty would have a chilling effect on business investment, both in the U.S. and in other countries. So this would be also a very damaging scenario for the global economy, at least in the medium term. So those are my thoughts about the global economy. I'm going to stop sharing my screen, and I'm very happy to take questions now.
Okay, great. Thank you very much for your illuminating opening presentation, along with excellent overview of what's happening in this battle over trade around the world. Thank you very much indeed. I would like to move on to question and answer session, Q&A session, starting with our invited guest commentators now. Let me get started with actually this gentleman as an urgent arrangement for being has to be excused early, so we put him first for his question. And I would like to welcome Dr. Daniel Shin, who is a managing director at MCI Group, an international luxury brand from Korea, and has served in many executive and board positions at Korea's leading corporations, such as Hanwha, CJ, and KT. Dr. Shin was nominated as a young global leader in 2016, that was almost 10 years ago, by the World Economic Forum. That's Davos Forum designated him as a young global leader. So let's invite a young global leader, Dr. Daniel Shin. You're on. Welcome.
Sure. Thanks for accommodating for my needs and then trying to stay young. Thank you for that. So Dr. Kalish, I really thank you for your great comments earlier. I always admire your candid view on global retail landscape with your annual report from Deloitte and also appearance at a major global retail summit such as World Retail Congress in upcoming May as well. To me, retail supply chain is international business. There's no doubt for that. Everyone is under pressure from radical shift of the new administration in the US right now. We all talk about challenges, but always you have a great balance on your report and the perspective. So if you may add on, what areas do you see as offering the strongest prospect growth next 2 years amid global target wars?
You mean it in terms of what industries or what
retail
locations?
In general, retail in general.
In retail in general? Well, I think it's I think we're going to see certainly here in the US a slowdown, if not a recession, which would have a big negative impact on retail. Plus the fact that I think whatever happens in terms of all the reciprocal tariffs that the president has discussed, it's likely we will still have fairly high tariffs with China. Maybe not the 145%, but maybe still fairly high. And if that's the case, then I think global retailers that source a lot of goods in China will probably look toward diversifying their supply chains further. We've already seen this happen over the last decade. Certainly when President Trump introduced tariffs on China in 2018, we began a process where many global companies were diversifying away from China. We saw in recent years a very sharp drop in inbound direct investment into China and a commensurate increase elsewhere, like Vietnam, for example, or India or Mexico. Right now, the uncertainty over where to go other than China is a problem, because if the U.S. imposes a high tariff on Vietnam, or if it ends the free trade agreement with Mexico, then maybe those aren't the right places to go. So right now, the uncertainty is probably leading retailers and their suppliers to take a wait and see approach. But ultimately, they will have to make a decision. If China is not economically feasible, they will find somewhere else to go. But in the interim, we will see higher prices here in the US, which means that maybe some other countries will be better in terms of global retailing. As I said, I think there's reason to expect a rebound in economic growth in Western Europe. And so Europe could become a much better retail market. In China, where the government is engaged in fiscal stimulus meant to boost consumer spending, and also using some structural reforms to encourage households to save less and spend more, that could potentially be a better retail market. And certainly India is now the fastest growing large economy in the world, which I expect to continue. So that's a very attractive consumer market as well. But in terms of products, I understand you're in the luxury space, and luxury goods are particularly popular in Asia, and I don't think that's going to change. But there might be some issues because of tariffs with the U.S. market.
Understood. Thank you very much.
Okay. All set? Okay. Thank you very much, Daniel. Next, I would like to invite Mr. Oh Young-jin, who doesn't really need any introduction over here, at least in Korea. He is currently president of the Korea Times, a leading English newspaper in Korea. President Oh has had a distinguished career in the media over the last 3 decades or so. So, Mr. Oh, floor is yours.
Thank you for kind introduction, and thank you, Dr. Kalish. I think it's a very interesting and stimulating, the presentation. My question may, attempt you, to get you out of your comfort zone. Something, some of the questions are, interconnected with the political implications as well. My number one question, and if you think so, just pass those questions. I got a couple of questions. Number one is, economy has as much to do with the sentiment as with the numbers and charts, they say. The sentiment in the world is, as we know, a funereal uncertainty. Numbers and charts, as you point out, as a dismal picture. Is it Trump taking us to the Great Depression or something similar to that scale? And if so, what is needed to avoid it? And if not, what more is needed to repeat it? A kind of a cautionary tale.
Well, I
That's
do
number
think,
one question.
okay, I do think the trade policy has the potential to create a global economic downturn. And I think there's maybe a 50% chance that here in the US we'll have a recession within the next year. I don't think we'll have a Great Depression. If you look at what happened in the Great Depression, it was to a large extent due to policy errors on the part of both the central bank and the Congress. Monetary policy remained too tight, and as did fiscal policy. We have learned since then a lot more about how the economy functions, about how policy functions, and in just 15 years ago, we learned how to avoid a Great Depression. When we had the global financial crisis in 2008 and 9, major central banks, including the U.S. Federal Reserve, intervened substantially, engaging in what was called quantitative easing to avoid a seizure of financial markets and avoid a drop in the money supply. And I think that would happen again. If the trade policy leads to a recession, central banks will intervene and will work to avoid financial instability, and will work to maintain liquidity. And I think governments also would probably engage in more expansive fiscal policies to offset the trade policy. And finally, if as we're already seeing, the financial markets react very negatively to trade policy, that might encourage the U.S. government to reverse the trade policy. I mean, for example, when markets reacted very negatively to the April 2nd announcement, that led to the April 9th announcement that tariffs were being postponed. So I guess to summarize, my answer is no, I don't think we'll have a Great Depression.
I got, the couple of, the follow-up questions related to your explanation as to the, my first question. Instead of, doing so, I got a couple of, other questions on separate, the fronts. My second question is about, as a citizen of the country who has just impeached the second out of our three past, the leaders impeached, and I understand there's some talks about the impeachment in the United States regarding the President Trump. Do you think that Trump deserves to be impeached on the the economic grounds, or if not, what more do you see needed for the process to begin again? As we know, there were two attempts to impeach him during his first term. I understand.
Well, he was impeached twice, but he wasn't convicted, and he was not removed from office. As to future actions, it's probably not appropriate for me, working for Deloitte, to comment on political issues right now. So I'll just pass on that.
On economic grounds.
I'm not going to comment on political issues. Yeah.
One last question. Our acting president says, the president has been impeached, and now he's a prime minister, has been acting on his not on his behalf, but as an interim leader. Our acting president says that Korea won't fight the Trump tariffs, and even promises to allow renegotiations on its deal with the U.S. on the burden sharing regarding presence of U.S. troops in Korea.
Yes.
Do you think that that this is the type of the preemptive the term preemptive appeasement? And do you think that this type of the preemptive the appeasement would be working with the Trump administration?
That might work, actually. I know that the president has spoken frequently in the past about the fact that the U.S. maintains troops in Korea and Japan and Western Europe, and has complained that those countries are not providing enough financial and military support. And so if a negotiation led to more financial support for the U.S. troops, that might be one among other factors that would lead the U.S. to agree to minimize tariffs. But I don't know for sure. I'm just speculating. So, but I do know that it was reported that in the discussions with Japan, the issue of the cost of the U.S. troops in Japan did come up in those discussions.
But it's the two separate part. The first part is he would submit himself to the whatever the Trump tariffs would be imposed on this country. Would it instead of the fighting and like Europe has been has been talking about the reprisal against the Trump tariffs, right? But what about the instead of the talking about reprisals, just the mom on the retaliation and the officially saying that we are not going to fight it. We are trying to accommodate the present the Trump tariffs as much as we can. What do you think?
So different countries have taken a different approach. In the case of China, there's been significant retaliation. In the case of Europe, they've talked about retaliation, but they've also talked about negotiation. They've engaged in some negotiation. One of the issues that the Europeans have raised is rather than retaliate by imposing tariffs on imported goods, they might impose restrictive regulations on U.S. service companies, especially in high technology. Keeping in mind that the United States, although it has a trade deficit in goods, actually has a trade surplus in services, and our service companies are globally extremely competitive. So from the European perspective, to create restrictions for U.S. service companies could be a good way to exert leverage with the United States in its negotiations.
Thank you so much. My last question, we cannot, finish any, the webinar without talking about China.
Yes.
And you talked about China as well. What is the chance that, the China will fill the leadership vacuum if it is to be created as the Trump antagonizing entire world, and then the effects of his the tariffs and his rhetoric, resulting the complete alienation of its the U.S. allies from the U.S.
Right.
And
so
on top of that, the Xi Jinping has been on a charm offensive, as we know. Please.
So yeah, it appears that one of the goals of the U.S. administration is to isolate China, but probably the best way to do that would be through its alliances, but evidently that's not the case right now. The threat of tariffs on allied countries has created potentially an opening for China to improve its standing in the world. And it's not surprising to me that immediately after so-called Liberation Day, the Chinese president visited Southeast Asia, including Vietnam, because Vietnam for a while was seen as the best alternative to sourcing goods as opposed to China. And in fact, the U.S. government had encouraged U.S. companies, rather than sourcing goods in China, to source them and invest in Vietnam. But then on Liberation Day, it was proposed that there would be a 46% tariff on Vietnam. So suddenly Vietnam looks to be more friendly to China. So I do see this situation as an opportunity for China to improve its economic and political relations with many other countries, to provide a perception of stability and openness that those countries don't necessarily see right now from the United States.
Were you did you feel liberated on Liberation Day?
Liberated from free trade. I don't know.
Thank you so much for your kind answers.
You're muted.
I'm muted. It's coming back.
Sorry. Oh, okay. I'm sorry.
Yeah.
Oh, okay. There was some. Oh, yeah. Okay. Thank you, Mr. O, for your interesting, rather sensitive questions from your journalistic instinct, which we fully understand. I would like to move on to the last invited guest commentator. Now I would like to invite His Excellency Ambassador Lee Jong-gyu, who has served as a Deputy Minister at the Ministry of Foreign Affairs, Secretary to the President of Korea for Foreign Policy Coordination, and Korea's Ambassador to the Kingdom of Sweden. Ambassador Lee is currently non-resident Executive Director of Korea International Cooperation Agency, known as KOICA, and visiting research fellow at Sejong Institute. Ambassador Lee, okay, you're on. Welcome.
Yeah. Very nice to talk over this webinar, Dr. Kalish, and I first want to thank you for your very insightful analysis and thought-provoking presentation. I want to focus on President Trump's America First policy, which is causing a lot of confusion and even shock, as he is indiscriminately dropping tariffs on many countries. As tariffs are a typical tool of beggar by neighbor policy, causing losses to the target country for its own economic benefit, and protectionist in nature, it is inevitable that the result will be a reduction in international trade and a downturn in the global economy. We are witnessing already some creaking sounds from allies and friends alike, and protesting voices from its own people inside the US. Would this policy, the tariff policy of Trump administration, be sustainable? That's my first question. And how long do you think it will continue, as he is creating hostile relations by imposing high tariffs on many allies and friends alike?
Thank you.
I don't know how long it will last. I don't know even what the actual policy will be going forward, whether we will see permanently higher tariffs, or we will see negotiations, or we will see tariffs imposed and then withdrawn in response to financial market volatility. I just don't know. And that's part of the problem right now, is the uncertainty about this. But certainly there is some damage to relations with allied countries. I think that in most countries, policymakers do respond both to voter sentiment as well as investor sentiment. So what we have seen already with investor sentiment is a drop in equity prices, a rise in bond yields, a drop in the value of the dollar. If that continues and becomes more volatile, perhaps the administration would reverse course as a way to avoid that volatility. As far as the voters go, there is some anecdotal evidence that there is beginning to be a backlash against the tariffs. Voters know that tariffs will lead to higher prices, at least temporarily. And the last election was campaigned on the basis of voter anxiety about inflation. So I think if there is a sharp rise in inflation again, it will be politically damaging to the administration, and that might also lead it to reverse course. But again, I don't know. This is pure speculation, which is probably not a good idea. All I do know is that the uncertainty right now is already having a negative effect on economic activity.
Okay. Is that all said, Mr. Ambassador? That's it? Okay,
thank you very much for your answer.
Okay.
I just have my second question. As one of the participants of this webinar sent a memo that to ask about the impact on Korean economies and Korean companies.
So,
what are the specific impacts of this trade policy on Korean companies, and how should they strategize in response? I want to hear your opinion on this question. Thank you.
certainly, Korea is a major exporter to the U.S. The U.S. is a very important export market for Korean companies. And the tariffs obviously would be very damaging. So I think there are maybe a couple of strategies that could be used. One is to try to diversify away from the U.S. and seek out opportunities for growth of exports to other countries, especially countries that are likely to have reasonably good economic performance. Second, it might make sense to invest more in final assembly of goods in the United States and then just simply export intermediate products. We've seen this happen in the past. For example, in the 1980s, there was concern in the U.S. about a flood of imported automobiles from Japan. So under the Reagan administration, there was a voluntary quota on auto exports from Japan to the U.S., and many Japanese companies invested in automotive factories in the U.S., and that helped to alleviate some of that political pressure. Third, as I indicated in my presentation, when it's difficult to compete on the basis of price, which is what tariffs do, then it makes sense to try as best as one can to differentiate products so that customers are not simply driven by price, but driven by the differentiated nature of the products, especially innovative products. So, for example, a very high quality automobile or mobile telephone or consumer appliance or whatever it is, if it has attributes that are unique and different than the competitors, then it can command a higher price. And so price competition becomes at least somewhat less important.
Okay, we're set. Ambassador Lee, thank you very much for your very productive intervention. Thank you. And we have only 5 minutes or so. So I would like to pursue a couple of questions, actually on behalf of our viewers. Some raised a question along this line. That is that the ultimate goal of this trade war invoked by Mr. Trump, now, he made it clear from throughout the campaign period and afterwards, he would like to see dollar to weaken so that have a better competitive advantage in exporting American products.
Right.
By that, the way we would interpret that, then the main counterpart of this trade dispute, Chinese yuan, he may like to see yuan to strengthen the market. How do you see this sort of foreign exchange dynamics to evolve from now on? Certainly, dollar has been weakening, but we haven't really seen the weakening of yuan reflecting manufacturers, the domestic economic situation and forth. So what is your take on this point?
Well, the Chinese, I think, have in recent years tried to avoid a depreciation of their currency because they know first that it increases the cost of servicing foreign currency debt. It can be inflationary, and very importantly, it leads to political problems with the U.S. because the U.S. has, for a long time, complained that the Chinese were undervaluing their currency and creating unfair competitive advantage for their exports. So it's not in the interest of the Chinese to see their currency depreciate. It is in their interest actually to see it appreciate. But given that there has been an impetus toward capital outflows from China, that does put downward pressure on their currency. So they've had to intervene to prevent it from depreciating. As for the U.S., normally, as I said, tariffs would lead to a higher valued currency, but we're not seeing that now. We're seeing a sharp drop in the value of the dollar as global investors evidently see the U.S. as less of a safe asset than they used to. So if the administration wants a cheaper currency, that's what they're getting, but maybe not for the right reasons.
So that's sort of a trend, at least a medium-term trend for moderating or weakening dollar to continue. Is that your view for various reasons?
That's hard to say. I mean, it's if I could accurately predict currency values, I'd probably be a very rich man. But I mean, there are many moving parts here. There are many factors that will drive the value of currencies. That includes what actually happens with tariff policy. It includes what happens with monetary and fiscal policy. And also, as the previous speaker noted, it depends on sentiment in the market and the perception that investors have about the future direction of U.S. policy and the U.S. economy. So I don't know where the dollar is going to go. So.
Okay. Yeah, I appreciate that. Perhaps the last question that I have is it's a rather open question, but I would like to explore this. Now, out of this ongoing trade war battle between number one, number two economies in the world, U.S. and China.
Yeah,
I think although you didn't specify it in your presentation, but what was might be there in Trump's mind, or Trump administration mind, is to weaponize tariff to reshape global order, if you like, geopolitical rebalancing, reordering.
Yeah.
Now, so perhaps that's the reason why United States put greater focus and pressure on China compared to many other countries. Of course, China has the largest trade surplus with the United States too. So my question to you is this: who's going to be the winner in this trade war in the end? Of course, it's very difficult to answer. Most economists would say that both to lose. But I'm asking you, on a relative sense, who's going to have more damage from this higher tariffs between U.S. and China?
I mean, there are no winners in a trade war. However, in the direct dispute between the U.S. and China, the U.S. has more to lose because the U.S. imports a great deal more from China. If those products become much more expensive, it's a loss of purchasing power for U.S. households and businesses to a much larger extent than would be true for China. Notably, in the last decade, there's been a shift in trade patterns where there's less direct trade between China and the U.S. than there used to be, and more trade between China and other countries, especially in the emerging world. So I think in this trade dispute, the U.S. has more to lose, especially as the U.S. has chosen to target not just China, but many of its allied countries. So the U.S. stands the risk of not having very many friends as a result of this conflict. And of course, this conflict is not new to this administration. The previous Biden administration had imposed substantial restrictions on trade and cross-border investment with China, not because of China's trade surplus, but because the Biden administration was concerned about several issues, about human rights in Xinjiang province. It was concerned about intellectual property theft, but very importantly, it was concerned about national security and the fact that China has significantly improved its military prowess using very advanced technologies, and the administration was trying to keep those technologies away from the Chinese military. So in a sense, what Trump is doing is an extension of what the Biden administration did. There seems to be in the U.S. bipartisan support for limiting relations with China. But the difference is that under Biden, the view was with China, put up a large fence around a small yard. So focus on what's most important, high technology, clean energy, and restrict relations there. The current administration, the policy seems to be throw out a wide net and limit economic relations across all sectors. So we'll have to see how that goes.
Right. Thank you very much. But I may add that according to Goldman Sachs and quite a few leading investment banks, their projection for the growth, GDP growth in coming year and next, it appears to be more damage could be done to Chinese economy, because some may contend that prior to this trade war erupted, the economic situation was rather weak or vulnerable to additional external shocks. I'm talking about Chinese economy. You mentioned that
China has grown
problems and so forth.
China has grown more slowly than in the past, certainly. But I think this trade war may compel China's government to engage in a more aggressive fiscal expansion as a way to boost domestic demand. So in a sense, the growth path for China will depend in part on how China's government, how its policymakers respond to this challenge.
Right. Okay. That's right. I think that's the right way to close our conversation. Thank you, Ira, for your brilliant presentation and stimulating discussion afterwards. Once again, I thank you very much for being with us today, and look forward to seeing you next time in person for our event. Okay.
That would be great. I'd like that. Okay. Thank you very much for having me.